cap rate is something that I wanted to put in right when we're talking about analyzing the deal, because it is one of the most common ways that investors figure out if this property is going to give them a decent return, the kind of return that they're looking for. So how you determine cap rate is, number one, you get the gross income. So all of the rents that are collected. If it's a larger rental, maybe there are coin operated washers and dryers, there can be candy machines, there can be all sorts of different additional charges, like renting out the parking spaces, renting out the sheds on the property for storage or small garages. So all of the income gathered together is your gross operating income. Then you're going to subtract the expenses, and then you'll be left over with the net operating income. So in this example, just so you have some real numbers to play with, if you're like me, you like to actually get the calculator out and punch in the numbers and see what that does. So it's not just a theory in the head, but it's an actual real potential scenario. So $18,000 of gross income during the year. And obviously this would be kind of a smaller property, just a small single family house, or maybe a duplex in the Midwest where it doesn't bring in a lot of gross income for the year. But this is a very realistic example of what you're going to get as a beginning investor. For most of you, you're going to start out with some smaller properties. So take that $18,000, subtract off $12,000 for expenses. That's going to leave you with $6,000 for the year for your net operating income. Now, why is that NOI so important? That net operating income is what you're actually going to use to determine if this property is a good price. And I'm going to tell you that is so critical, because if you have a house that costs $200,000, but it only rents out for $600 a month, versus one in a different city that might rent out for $1,500 a month for that exact same investment of $200,000, your cap rate is going to be very different. So when you're sticking with rentals, it's not about the after repair value like it is on a buy, fix, and flip. Your NOI, net operating income, is going to be divided by your purchase price, or whatever you're going to offer as a purchase price, not necessarily the list price, but what you actually buy it for. That's your purchase price amount you divide it by. And then that will give you a cap rate. So that looks like this. In example one, if you took that $6,000 NOI and divided it by $40,000 for a little teeny house somewhere in Ohio, then you're looking at a 15% cap rate. Okay, you're going to get a number, you just multiply it by 100 to get the actual percentage for your cap rate. In another example, you could have a lot higher NOI, but if you're dividing it by a much more expensive purchase price, you see how the cap rate is much lower. So it goes 0.054 times 100 equals 5.4% cap rate. Now that was actually a property that I sold. Well, we bought it, we held it and cash flowed it and sold it by a university. So a 5.4% cap rate on something that's just going to be pure cash flow, it's just a cash flow property, and you're not really expecting it to appreciate a lot over the years, maybe 3% per year average, versus something in a very hot market, a very strong rental market right by a university that's going to appreciate a lot. Well, now you're juggling between what the cash flow is, so that 5.4% cap rate, plus all of the equity. Together they make a good deal. Where sometimes you just want a really good cash flow because that's your goal for the next 5 years. All I want to do is buy these little properties that cash flow. Well, then you're going to be looking for properties with cap rates at 10% or higher. And you can actually get those on properties in certain cities. In other cities, you're going to be hard pressed to even get above 8%.